This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
So let's go through and look at the third accounting standard related to our non-current assets and property, plant and equipment. And it's changing it up a little bit by looking at investment properties. So it's looking at tangible non-current assets that essentially aren't property, plant and equipment. Okay, sounds a bit strange, doesn't it? So let's divulge a little bit further, shall we? So we're going to go through and look at what an investment property is. It's very literal. It's a property held for investment purposes. And then we need to think about how we measure the investment property. Okay, and we will talk about why we measure it as such as and when we meet it. Okay, so first of all, what is investment property in IAS 40? It says there at the top, investment property is property. What do we mean by property? Property is land and buildings, isn't it? Or land or buildings. So if you have an investment that you haven't put into land or buildings, then you need to be careful, because you could buy land or buildings that you would use for your day-to-day business, or you may buy some land or buildings to invest in. Okay, you're not going to use them, and if you are investing that money in land or buildings, then maybe you are going to earn rentals, or you're going to look for some capital appreciation. So maybe you've gone through there, you've got a bit of spare cash within your business, you think, right, let's go and invest some money in the property market in London. That always seems to be booming, doesn't it? Okay, I think there's a lot of overseas investors that have taken their money into London and invested in that property to earn more money in the future, whether that's by selling it for capital appreciation purposes or for renting it out to people who live in London on their day-to-day basis. So that would be investment property. Yeah, it's land or buildings, or maybe part of a building. So maybe you've got a big, tall building, 40 stories high. Maybe one floor of that you decide to rent out. Okay, so that floor would be investment property. The rest, if it was for your own personal use, that would be nice, wouldn't it? 39 floors, my own personal use. Will be property, plant and equipment. But there you have it. The key bit is then thinking about what is not investment property. So things that are used in the production or supply of goods and services, or for admin purposes. What does that mean? Well, the production of goods is your own company warehouse, isn't it? Or your factory. Yeah, that's where you produce the goods. Therefore, that is not an investment property. It is property, but it's not for investment purposes, is it? You're not renting it out. You're not using it for capital appreciation purposes. It's there for your day-to-day business. So that talks about production. What about the supply of goods? Well, if you're thinking about the supply of goods and services, maybe that's your shop premises. Okay, you've bought your shop premises on the high street. You're not renting it out to anybody. It's not there for capital appreciation purposes. It's part of your day-to-day business. Okay, and also the admin purposes. That's your head office, isn't it? You've constructed your head office, or you bought your head office. It's there under IAS 16, isn't it? You're not renting it out. It's not for capital appreciation purposes. I think that they're the ones that tend to make sense. The next one's a little bit more challenging. Investment property is not property for sale in the ordinary course of business. So if you have bought a property, if you have constructed that property for a third party that you are then going to go through and sell, then that is not investment property. Okay, if your day-to-day business is buying and selling property, or constructing property and selling that property, so key bit is your ordinary course of business. So is it your day-to-day business to construct the property and to sell it? Then that's covered there by IAS 2, because effectively that is your inventory, isn't it? Okay. And then the other one that is not investment property is property whereby you are building it for future use as investment property. Okay, so what you do there is that is treated as IAS 16. Once it's completed, it is now there for capital appreciation, more purely for rental purposes. So then it becomes investment property. Okay, So key bit is that what you've got there is the investment property is land or buildings for rental or for capital appreciation purposes. It's not something that you use yourself, because if you use it yourself, whether that's using it or constructing it, it's treated elsewhere, either PPE or IS2 in inventory. And if it is for a future use of investment property, then therefore it will become investment property when it's complete. Okay, so it's important to know what investment property is, because once we've got that, we can then think about the measurements. Okay, and again, what you can see there is that is split into two, isn't it? It's spoken there, is it about your initial measurement and then your subsequent measurement. Initial measurement, nice and simple. It's there as your cost plus your directly attributable cost. So like we've seen previously in PPE and IAS 16. So your cost, what you pay to acquire the land or building, and then maybe any stamp duties, any legal fees on top of that can all be capitalised. So nothing too untoward or extraordinary there, shall we say. Subsequent measurement is where you just need to be a little bit careful, because you have two methods that you can use. The one that is used by most people, and it makes sense to me, is you use the fair value model. Okay, it's a ridiculously straightforward method of accounting. All you do, it's very literal. You look at the fair value at each reporting date and revalue it to fair value. Okay, just be aware, unlike IAS 16, where you need a professionally qualified valuer, there's no specifics within IAS 40 that say you need a professionally qualified valuer, but that's just a small little bit to one side. Okay, you revalue it to fair value. Okay, the key bit now, however, is that it is an investment property, isn't it? So if you've invested in property, the treatment should be no different to whether you've invested in shares. Now, you've just decided to go into property because that's where you think you can make more money than by investing in shares. Now, if you invest in shares, the value of the share goes up, the value of the share goes down. Gains and losses, as you will see in future subjects, go into profit or loss. Okay, so why should it be any different if you've invested in property? Why should the gains or losses go elsewhere other than profit or loss? Okay, you've just invested in something different, so the accounting treatment should be the same. Okay, shouldn't it? Doesn't matter what you've invested in, just because it's different doesn't mean to say that the accounting treatment should be different. The accounting treatment is the same, and therefore any gains or losses that you make, they go through there directly or immediately through profit or loss. Okay, important. None of that nonsense in IAS 16, whereby you take your gains through other comprehensive income, and then if there's a reduction, use the other comprehensive income, and then anything else goes to profit or loss. None of that nonsense. Gains or losses all go to profit or loss under the fair value model. And the key bit therefore then is that property is not depreciated. We'd never depreciate land anyway, but if it's a building, it is not depreciated under the fair value model. Okay, most entities would decide to go through there and take that option, okay, because they have invested within that property for investment purposes. Okay, the other option that you've got is the cost model. Oh, yawn, boring, not much going on there. You know, there is an alternative whereby you capitalize the investment property at cost and then depreciate it. Okay, so you capitalize it at cost, you depreciate it. There's a small particular rule that says that you must disclose that investment property's fair value, but that's not really very exciting, is it? Now, you've seen all of that under IAS 16 and property, plant and equipment. Why worry about it? Okay, you can do that already. The key bit is the fair value model. You revalue your investment property to fair value at each reporting date. Gains and losses go through profit or loss. Have you got that? Are you sure? Positive? Where do gains and losses go? Excellent. Profit or loss. Okay, so you're with me. That's good. The key bit, because all of that's just way too simple, I think, is to then go through there and start to look at what happens as we go through there and change how we use that property. Okay, so before, I think it was mentioned, wasn't it, that it would not be investment property if we used it ourselves, or maybe it would not be investment property if we were selling it in a normal course of business, because it is our business to construct the house and to sell it on to somebody else. But what happens if things change? Maybe we had owner occupied property under IAS 16, and then we moved to new premises and decided to rent out the property that we previously occupied. How do we go through there and decide to change things up? Okay, you've got a couple of rules there. Okay, the first two are going from investment property to another accounting standard, whereby the bottom two are going from a different accounting standard into investment property. Okay, so on the first two, investment property to owner occupied or investment property to inventory, the key bit is to get it right before we then change. I think that applies under all of them. So given it was investment property previously, we will get the fair value at the date of change or at the date of transfer into inventory. Okay, so again, you would take to the fair value gains and losses through profit or loss as normal under IAS 40, and then account for it as PPE, so depreciate it, or then account for it as inventory, value it at the lower of cost and net realizable value. Okay, nice and simple. Just be careful under the others. If we go from PPE IAS 16 to investment property, so we use the building ourselves and then decide to have it as investment property, then what you've got there is you need to revalue it under IAS 16 first. So remember, first of all, under IAS 16, any gains go to other comprehensive income, don't they? And then treat it as investment property. Okay. If it's inventory, then to investment property, again, fair value on the date of change, and here the gains and losses go to profit or loss. Okay, don't value it under the lower of cost and NRV. We look at what that inventory is actually worth before we then transfer it into investment property. Okay, we've got a very small example just underneath there, just to go through there and look at the changes and what goes through there and happens. So it wants us to explain the accounting treatment of the property. So again, is it investment property? Is it PPE? Is it inventory? We don't know. For the year ended, is it there the 31st of December 2015? Okay. It says that Adlington owns a property that it is using as its head office. So if you have it as its head office, then that's PPE and IAS 16, isn't it? The 1st of January 2015, its carrying value was 20 million and its remaining life was 20 years. So we could depreciate that 20 million over the remaining 20 years, can't we? The 1st of July 2015, so is that there? After 6 months, the business was reorganised, cheaper premises were found for use as a head office. It was therefore decided to lease the property under an operating lease. Don't worry too much about the words operating lease. You see that in F2. Okay, but we're now going to lease the property. So therefore, we are holding the property, aren't we, for rental potential. So if that's the case, then what you have is it is investment property, isn't it? Okay, so it's going from IAS 16 PPE into investment property under IAS 40. Okay, so what we need to do is we need to get it correct under IAS 16 first. So by that, we need to record any gains through OCI, and then subsequently gains and losses at the year end fair value will go to profit or loss. What does that say? The property was valued by a qualified professional, which is what you need under IAS 16, to assess the property's value at 21 million on the 1st of July. So we'll need to treat that 21 million under IAS 16. And then at the year end, it has 21.6 million, isn't it? Okay. So there's an additional gain to the end of the year. Okay, so initially we had it there, was it as property, plant and equipment, wasn't it? So we need to get the value of the asset at the date of change, don't we? So we've got the cost, the depreciation. We need to get the carrying value at, is it the 1st of July, wasn't it? The cost was there as 20 million. The depreciation is where you need to be a bit careful, because it's the 20 million divided by 20 years. But be careful, 6/12, isn't it? It was there the 1st of July. It's halfway through the year, isn't it? So it's not 1 million. It's 0.5 million, isn't it? So my carrying value is 19.5 million at the 1st of July. Okay. We then need to revalue it, don't we, to fair value. And that fair value was 21 million, wasn't it, at that date? So the difference that you have is 1.5 million. That 1.5 million is a gain, isn't it? And that gain goes to other comprehensive income, ladies and gentlemen, because we are treating it as property, plant and equipment, getting it correct before we then go through and start thinking about IAS 40. Okay, so that gain of 1.5 million goes to OCI. Okay, happy with that there? Yeah, it's what we saw in the earlier chapter, isn't it? How to revalue an asset under IAS 16. What we then have is it now becomes, is it investment property? So the rules of IAS 40 apply. So what we're going to do there is we're going to take it from 21 million up to, is it 21.6 million, which is the fair value, isn't it? So the 21.6 million is shown on the statement of financial position. And then what you have there is that there is a gain of 0.6 million, isn't there? Now it is an investment property. So the gain, or even if it were a loss, goes to the statement of profit or loss. Okay, there you have it. So on the SFP at the end of the year, you have 21.6 million. There's a gain of 0.6 million, and there would have been depreciation, I think, of 0.5. So just to summarize it all, because I think a lot's gone on there, hasn't there? Let's go through and look at the summarized financial statements for that year to December. So SFP, statement of profit or loss and other comprehensive income. On the SFP, I have investment property. Is it at 21.6 million at the end of the year, isn't it? That's its fair value. In profit or loss, don't forget that you have the depreciation, was that of 0.5 million. You also have the gain, so we'll put the depreciation in brackets to show it as an expense. And the gain on the investment property was 0.6 million. In other comprehensive income, you also have a gain, and that gain there through other comprehensive income was 1.5 million, wasn't it? Because that gain arises when we transferred it out under IAS 16, and then once it was there as investment property, it then was treated under IAS 40, wasn't it? Okay, there we have it. Again, once we treat it under investment property in IAS 40, we stop depreciating it. Hence, the depreciation that we have within the question is just for those first 6 months, isn't it? Okay, there you go. You know what I'm going to say. Have I got the questions? Work them through, keep practicing, and if you get stuck, we're here to help. Other than that, I'll see you all in the next session.